Hello everyone and welcome back to my channel. Today we will be going over TFI International, the company itself, and then we will cover their quarterly report. We will follow that by an interesting ETF that I'm considering starting a position in. Here are the timestamps. We start with TFI International, an acquisition company that focuses on acquiring distressed transportation and logistic assets to add and synergize them to their extensive and diverse last-mile delivery portfolio, which operates all across North America, all the way from Canada to Mexico. TFI's strategy is very interesting and seems to be working out for them. Once they acquire a smaller company, they give them a considerable level of autonomy and do not attempt to assimilate the new subsidiary's operations to that of a quote-unquote company's culture. This strategy allows their new subsidiaries to cater to various different regional markets, maintaining a niche and strong customer base, along with a diversified portfolio and lowering many restructuring costs that usually come with acquisitions. TFI has provided a 35% capital appreciation for their shareholders year to date, an impressive 136% in the past 5 years. Let's go over some ratios and numbers quickly before diving into their earnings. TFI is a $5.54 billion company with a trailing PE ratio of 15.73, much lower than the transportation industry average of 23.5, and a price to book of 2.46, which is in line with the industry average of 2.5. Moving on to dividends, the company pays out a 1.7% dividend with a 27.44% payout ratio. The low dividend and payout ratio are attributable to the growth mindset of management. The company is currently experiencing explosive free cash flow growth with which they continue to acquire new companies, while maintaining a 10% average annual dividend increase streak over the past 10 years and a very low payout ratio. Very impressive indeed. The company is producing $783 million in operating cash flow, which gives the company a price to operating cash flow ratio of 7.1, which is half of the average in the S&P 500. Finally, the company sits at a current ratio of 1.17, which is obviously not as high as we would like to see, but considering how high their cash flow is, the current ratio does not worry me as much. In fact, as we will see later on in their statements, the company could almost pay off all of its current liabilities of $908 million with their current operating cash flow of $783 million. Let's now take a peek at their latest quarterly report. Management is quick to point out that current online shopping trends have been favoring the company. Here are some of their financial highlights for Q3. Operating income increased by 18% relative to Q3 of 2019. Net income increased 34% relative to the same quarter last year. Cash from operating activities saw a slight increase with free cash flow growing by 27% year over year. Here are some of their sector-specific breakdowns. As we can see, their largest producing sector is truckload operation, which saw a slight decrease of 2% year over year. Other sectors saw growth, with logistic operating income seeing a drastic increase of 117%. Management also points out the recent dividend increase of 12% over the previous quarter's dividend. And finally, we can see some acquisition news for the past 3 months. But let's be a little bit more detailed. Here are their total of 8 completed acquisitions during the last quarter. As you can see, this company is very much growth focused and continues to create a vast diversified network of trucking and logistics assets portfolio. You can pause the video and read through these if you're interested. Let's now look at their financial statements, starting with their balance sheet. We can see that current assets have increased a significant amount year over year, mostly attributable to a massive increase in cash. But I would like to point out that intangible assets, which include goodwill, make up almost half of their total assets, which is expected from an acquisition company, but nevertheless should be subtracted from total assets for a conservative analysis. Current liabilities have increased significantly, with total liabilities decreasing due to the company paying off a lot of its long-term debt. If we subtract liabilities from assets, we get that the company has increased their book value by a considerable amount year over year. But once again, I do not like how much intangible assets the company is reporting. Completely subtracting these from total assets would not be appropriate though, because the company is able to resell these intangible assets at a profit and has been doing so for the past couple of years. But it is nevertheless a figure to be very careful of. Next up, we have the cash flow statement, which is very long and you can pause the video if you wish to look into it with more detail. But it can be summarized by the following table, where we can see that cash from operations saw a slight increase. The company has slowed down their aggressive acquisition mindset, and one of the reasons may be to keep more cash on hand for the uncertainty of the pandemic, which resulted in a massive increase to free cash flow. Finally, we have our income statement, where we saw a slight decrease to revenue and an increase to net income. I paid less attention to this statement and more to the cash flow statement of the company, as I believe that due to the nature of this company, where depreciation and amortization have such a big impact, cash flow provides a far better insight into the effectiveness of management. I would like to finish this analysis off with some analyst valuations, but I would like to preface with the fact that you should never ever make a decision based on some analyst report. Let's start with simply Wall Street's valuation analysis, which is based on cash flow to equity model, which predicts that the company is trading at a 43.3% discount. Obviously, this number is to be taken with a grain of salt, as this simple model cannot determine the intrinsic value of the company. Next, Yahoo Finance has 6 analysts saying hold and 6 saying buy. TipRanks has 13 analysts recommending a strong buy, giving a year from now price target in between $84 and $66 a share. And finally, we have MarketBeat recommending a buy. No matter how many analysts recommend the purchase of a stock, you should never buy or sell based on their recommendations. But it does provide us with the knowledge that in general, the company does seem to be undervalued. And with some of the previously discussed ratios, such as a 15 PE ratio and an impressive 7.1 price to operating cash flow ratio, we can see that with a little bit more research on your guys' end, this could provide with a very interesting value investing play. This company has a lot of tailwinds with the current e-commerce trends, and as the holiday season approaches, I expect that a lot more online orders from sites like Amazon will help the company. But I will be looking into starting a new position in TFI over the coming weeks. The current market volatility, I believe, will present some very attractive entry points for this company, and I recommend that you all go out and do some research on the company and keep a close eye on it. We continue with the ETF TECH.TO on the Toronto Stock Exchange. This is an ETF created by TD Bank in May 2019. This ETF seeks to provide Canadian investors with exposure to solely the technology industry, mostly from the US, but also with some international exposure, as we can see from this chart. 84% of the portfolio is in US equities, with European, Japanese, and Asia Pacific trailing. You guys might be thinking, why not buy QQQ instead? The difference between QQQ and Tech.to is that QQQ is the top 100 companies in the NASDAQ, which, while being tech-oriented, you will still end up owning companies like Pepsi, Costco, and Starbucks, and many more non-tech stocks. I'm not saying that QQQ is not a good investment, but for people searching for a pure technology ETF, Tech.to provides a unique investment opportunity that I am very interested in. Let's now look more closely at this ETF. Being in a niche sector in international markets, this ETF requires a little bit more management than, say, VFB from Vanguard. Therefore, the MER comes in at 0.39%, meaning that for every $100 you invest, 39 cents will be deducted annually, or for every $10,000 you invest, $39 will be deducted annually. The ETF tracks the Selective Technology Leaders Index, which is a bundle of traditional tech companies, but also some disruptive technology companies in other subsectors. They give some examples here, being cybersecurity, artificial intelligence, autonomous vehicles, and much more. If we look at the industry breakdown, you might think, hey, I thought that this was a pure tech ETF. And it is, but some of the companies that it holds are fintech companies in other sectors. Take Visa or MasterCard, for example. They are considered to be in the financial services sector, but in reality, this is more of a technology company than a financial institution. Here, their top 10 holdings will have companies that we expect, such as Apple, Microsoft, Facebook, Google, Visa, etc. But what really interests me about this ETF are the lesser known holdings that I gain exposure to if I buy into this ETF. These include Salesforce, SAP, IBM, Oracle, Texas Instruments, Autodesk, Workday. There are many more. I strongly suggest that you guys take a look at their list of holdings on their website. As you would imagine, this ETF has returned a strong 28.7% capital appreciation year to date. A very high percentage indeed, but also not so big that it gives us flags of it being in a bubble. And the reason for this is that it is highly diversified. In total, there are 238 holdings in this ETF. It yields about a 0.72%, as is expected from the industry that it covers. Their current price to earnings is 40.6, and they have a price to book of 7.8. I think that this is an extremely unique investment opportunity, not only because it provides exposure to the big tech companies dominating the stock market, but it encompasses all of those smaller, more niche companies like Autodesk, Workday, and DocuSign that you may have never heard about, that are yet to be discovered, or that are too small for hedge funds to invest in. Not only this, but it also provides international exposure. It is definitely a riskier investment than, say, buying into a utilities company or buying an all-market index, but it is less risky than exposing yourself to tech through an overvalued company like Tesla or a recent IPO like Snowflake. I'm not advising you guys to go out and buy shares of this ETF, but I think that not many people know about this opportunity and should look more into it. I personally am waiting on the sidelines with some cash, waiting for a correction that allows me to start a position in this ETF. With that, I would like to thank you all very much for watching. Please don't forget to subscribe and give me your opinions on TFI, TECH.TO, or any other company/ETF on your radar in the comments down below. I will see you in the next video.